Good afternoon, everyone. We're thrilled to have you with us here today for an exclusive webinar hosted by BDO East Africa. My name is Meha Patel, and I'll be moderating today's session. So in today's webinar, we will be diving into the 2025 Finance Bill and its implications for businesses in Kenya and across the region. Our expert tax team is here to provide an in-depth analysis of the key proposals and how they will shape the fiscal landscape. So before we begin the session, I'd like to encourage all of you to introduce yourselves in the chat, say your name, the organization you represent, and where you're tuning in from as we wait for more people to join. Thank you. Thank you, everyone, for introducing yourselves in the chat, and for everyone else who has joined us here, welcome. A few household items before we start. We will not be sharing the slides of this webinar, but we will upload a recording on our YouTube page, BDO East Africa. So please like and subscribe our YouTube channel where you can explore all our webinars throughout the years. And regarding the question and answer, we recommend using the Q&A tab at the bottom of your screen to submit any of your questions, and we'll be able to discuss these questions at the end of the webinar. Thank you. I'll begin with the agenda for today. So today we'll start with what led to the 2025 Finance Bill, and then we'll talk about income tax, VAT, excise, levies, and procedures. And then we'll talk about the industry impacts. We'll talk about manufacturing, SMEs, housing, digital economy, and then executive priorities, risks, opportunities, timeline, and action, and how to engage the Parliament. And last, we'll talk about preparing your business and how BDO can help. And then we'll also end with a Q&A session. I'd now like to take the opportunity to introduce our panelists for today. Zahir Sheikh is the Partner of Risk Advisory, Internal Audit, and Forensic Services at BDO East Africa. He's a dynamic leader with a high public profile and has been a market leader in his chosen markets and services. He was a regional partner responsible for financial advisory services at KPMG, and he has over 30 years of experience. Thank you for joining us. Next, I'd like to introduce Steve Okoth, who is the Tax Advisory Director at BDO Kenya. His expertise is overall, but he specializes in transaction structuring, dispute resolution, management of tax audits, international tax, transfer pricing, due diligence, customs, and management of revenue authority processes. He has over 15 years of experience. His practice has also covered advisory disputes, due diligence, and international tax matters in Uganda, Tanzania, and Rwanda. Steve is also a member of the Kenya Private Sector Alliance's Public Finance Sector Board, and he also supported the State Department for Housing and Urban Development in preparing tax exemption protocols for affordable housing projects. He's a tax lawyer trained at the University of Nairobi and has undergone specialized postgraduate training in international tax and transfer pricing. Thank you for joining us. Now I'd like to talk about our tax team. Our panel today brings together a wealth of experience in tax advisory, international tax planning, and business management, providing expert insights into the 2025 Finance Bill and its implications. John Kumo is a senior manager in tax compliance department at BDO with over 8 years of experience. Then we have Magdalene Wavinya, who is an experienced professional with over 10 years of experience across the tax advisory. And then we have Koti Monzia, who has over 9 years of expertise in strategic management, corporate restructuring, and international tax advisory. Then we have Barbara Oloch, who has 9 years of experience and specializes in tax advisory. We then have Kelvin Gochoki, who is a senior consultant at BDO with over 3 years of experience. We also have Yadel Amusengeri, who has over 4 years of tax consultancy experience and is specializing in international tax. And last, we have Hati Adiambo, who has over 1 year of experience at Kenya and Rwanda in tax. So together, the panel brings over 40 years of combined expertise in tax advisory, international tax planning, compliance, and dispute resolution. With deep industry experience across multiple jurisdictions and sectors, they offer invaluable insights for navigating the evolving tax landscape in Kenya and beyond. Now I'd like to hand it over to Zahir Sheikh to introduce BDO East Africa.
Thanks so much, Meha, and a very warm welcome to all of you. Really excited to see the numbers. The numbers are just shooting up. We got 184 participants. Fantastic. That's really good. It makes us really happy when we have such big numbers because it basically makes it worth our while to come and spend the time and basically, put something together for yourselves. So welcome all of you. Very excited to be here today. We're looking forward to a really exciting session with our huge group of panelists. But before I can let them get to you, let me just talk a little bit about BDO. A lot of you do know BDO, so please bear with me. But those of you who don't, BDO is a global accounting, audit, and advisory firm. We are actually the fifth largest globally. We have a presence in 166 countries with over 1,800 full-time offices. We employ nearly 120,000 staff globally. This is last year. Last year, in terms of sizes, our revenues exceeded 15 billion US dollars. And you can see the 4 lines of service there: audit, tax, advisory, and business services and outsourcing. Meha, next slide, please. Thank you. So in East Africa, we're unique and we're very proud of it. And I'll tell you why we're unique. We're unique because we have one partnership across 6 East African countries at the moment and soon to expand to 9. And we already have the largest East African footprint of a single audit and advisory firm. That's correct. You heard me right. We do have the largest footprint in East Africa. Why are we unique? We're unique because, number one, it's one partnership. So one document, everybody signs up to it. But what does it mean for our clients? What it means for our clients is you get a seamless service. All of our offices are connected together seamlessly. At the end of a phone call, we're able to share resources and expertise. And we have one system, whether it's a training system, whether it's the MS Office suite of documents, as well as all of our other standards. They're all the same. Our practice management system is the same. And what that translates for our clients and our customers is really a higher level of service, multilingual, connected across all these countries, and able to respond really, really fast. I think that's what sets us apart, and it's something we're really happy, and we intend to continue increasing our footprint. At the moment, we have permanent offices in Kenya, Uganda, Tanzania, Rwanda, Ethiopia, and also the DRC. We've got 3 offices in the DRC. So if you're not using BDO in audit or in advisory services or in tax, please get in touch with our offices, and we'd be more than happy to receive you over a cup of coffee. Next slide, Meha. Let me just tell you a little bit about our services, and I'll leave tax for last because this is the tax webinar. I'll start off with advisory services. So I head the advisory services division and regionally in East Africa. And essentially, you can come to us for things like risk management, internal audit. We especially do outsourced internal audit. So say, for example, some of our clients don't want their own team. We can come in 4 times a year, once every quarter, and we can do the internal audit covering all of your systems, all of your departments at a fraction of the cost that it would cost you to maintain your own internal audit resources for the whole year. I can tell you our staffs, our clients who use us save up to 75% in costs as a result of outsourcing the internal audit to us. We also have a very busy deals advisory division. Deals advisory is something BDO is very proud of because we are number one globally. And what I mean by this is for many, many years, we have had the highest number of deals, whether it's mergers, acquisitions, takeovers, higher than anybody else globally. Not in terms of US dollar values, but just in terms of the numbers, because we're kind of large to mid-size. We get a lot of family sized businesses, family owned businesses, and mid-sized businesses. But what does that mean for our clients? What it means for our clients is they trust us, because when you're doing a deal, it could, if it doesn't succeed, it could not just spell disaster for the actual deal itself, but it could even spell disaster for the existing company. And therefore, you want to be going ahead with somebody who is going to take you across the finish line. And we're very proud to say that we've got tons and tons of experience. So if you're expanding, you're taking over companies or anything in that region, please contact our corporate finance and our transaction advisory division. We also do forensic investigations. That's something that I head. I started the first forensic chapter in Kenya back in the year 2000, and it's grown substantially now. So if you've got fraud, you've got any other misconduct, please contact us and we'll sort it out for you. We might even be able to bring some of your money back for you. We also have an IT advisory division that provides cybersecurity, data protection services, and we also have an ESG division that looks at environment, social governance, sustainability, reducing your carbon footprint, all of those things. So that's a little bit about the advisory services. We then have our standard audit department, which is basically statutory services, external audit services, but they also provide specialized services such as donor audits of special purpose vehicles, and also they provide a lot of training in IFRS and other assurance related services. And then we have an outsourcing department that sits there just as an outsourcing department. So basically, you can outsource a lot of things from your organizations to this department, such as accounting and bookkeeping, compilation of your management accounts, your management reporting, your annual statutory reports, financial management agent services, fiscal management services, payroll services, company secretarial services, legal services, and a host of other services. And finally, the stars of today, our tax department. Steve heads very proudly our tax compliance services as well as our tax advisory services. These are departments that provide sterling service to our clients. On the compliance side, we can do your returns, whether it's VAT, whether it's PAYE, we can do all of that for you. On the advisory side, we've got a really good track record of helping our clients on tax audits, on tax health checks, transfer pricing, employment tax, expatriate taxation, corporate international tax planning, indirect taxes, customs duty, and so on and so forth. But in particular, we specialize on resolving large-scale disputes. We've worked with all the revenue departments across East Africa. We understand, what they want. We understand the kind of rigorous process they have, and we are able to prepare our clients so that our clients have the best chance of succeeding when they're hit with legal claims. So that's enough for myself. What I'm going to do now is I'm going to hand over to Steve to take you through today's session. Steve, welcome.
Thanks a lot, Zahir, and thanks a lot everyone who is joining us today. This webinar is a special project that we prepared for our clients and all the people that we work with in the industry, the people that we provide services to. And the goal of this particular seminar is to take you through the finance bill. What is in the finance bill 2025? what the implications of that particular bill is. You will need to understand this and what you need to do in regard to the potential implications of the bill. So this is really the goal of the session today, for you to understand the bill in depth and what it portends to your business and what you can do. So I'll begin by the overall perspective of the government for bringing this bill before the National Assembly for consideration and subsequent enactment. Of course, there are going to be amendments and changes to the particular bill. But the spirit that has informed this piece of legislation, both communicated and also what we can read from the black and white letters of the proposed legislation, is the government is trying to manage the public expectations while also balancing against increasing the revenue pressures. There's pressure for the government to spend more on infrastructure projects, pressure for there to be more funds being provided to the county governments, pressure to manage things like healthcare and education and welfare, while at the same time, Kenyans do not want to hear of any additional taxes. So this is what then informs some of the proposals that you will see, both in our newsletter and for those who have read the bill itself. They are trying to restrict refunds as much as possible, give government more time to pay the refunds, and at the same time, they are trying to tighten the loopholes or that lead to revenue leakages, and also expand the tax base, bring more people from the informal to the formal treatment for tax purposes. And this is really what is coming out from the bill. It is administrative measures that are being put in place. We wait to see how this play out, given that from the experience globally on tax, administrative measures are known to have not more than 3%, even if you put the most efficient, the most effective, the most well-done administrative measures, they cannot exceed our revenue measures before they were put in place by more than 3%. So all these administrative measures, they are not likely to achieve much in the overall scheme of things. We go to the next point as to what really has transpired. Last year, when the finance bill was presented before the National Assembly, we saw the amount of chaos that took place in this country. And that really informs the tone of this particular bill. There were a lot of complaints that public contributions were not properly engaged. There were discussions in public participation, yes, but there was a feeling that there was no listening ear to the public concerns. And there were a lot of new taxes that were introduced. There has been a statement in the presentation of this bill that there are no new taxes. There are some new taxes, but not as much as last year. But it shows you exactly what the tone is coming from, that there is a lot of pressure for the public to be effectively engaged. And there is a mood to engage the public. I have been personally involved in this particular dialogue, and I believe there is now opportunity for the government to listen to the public when this particular bill is being reviewed. Controversial clauses that were enacted in the past 4 years, some of them are still in the law, and the reforms that were placed in December on 27th, some of them were positive and others were not. So this is really in tone with the idea of the government to increase revenue collection from 16% of GDP to 20% of GDP. I've already expressed my concerns that the literature out there and the research is that administrative measures are not likely to boost our revenue collection by such huge amounts. What really works to improve revenue collection is the overall health of the economy. So if the economy does much better, if the economic growth is significant, then we are likely to see the expectations being realized. But so far, these administrative measures, if it goes by literature or that is out there on revenue administration, they may achieve a maximum of less than 3%. So the issues that still the public and business sectors are grappling with are a number. One of them is the cost of living. There's a feeling that the cost of living has not gone down significantly. And this is one of the issues that led to the situation that we had last year. The other one is the deficit in trust. There's a lot of pressure from the public that they want to see more transparency and more honesty in a fiscal bill of preparation and legislation. Some work is going on this, but we are still a long way to achieving a situation which is satisfactory enough to build the public trust back to the policy making. It's quite a lot of concern still. VAT refunds are still an issue. Exporters are still dealing with this issue of VAT refunds. People who are in the zero-rated sectors they are having refunds locked up and they are not being paid in good time. And this is just causing quite a bit of concern because you have to pay the bank to keep this backlog not being paid to you. So there are measures to improve the VAT refund process, but they are merely administrative fine-tuning to push the ball to improve the process. The only solution will be for more funds to be provided for the refunds. The idea is for the government to cut down on refunds, but that is not going to help the exporters who or their products have to be zero-rated, and people in specifically incentivized sectors. There have been proposals to overhaul the tax system, and these ones we are going to see the measures that are going to be placed. This is not coming in the finance bill, but we expect there to be a new or an improved income tax act in the next several months or within this year. So I'll jump on to the income tax changes that have been proposed by this bill. One of them, the main one, which I have seen here, there are 6 major proposals in income tax, which are likely to have a material impact, and business leaders need to pay attention to this. The first one is the limitation of tax losses carried forward. This bill proposes that tax losses be limited in terms of carry forward by 5 years. So it means after 5 years, you cannot utilize the losses. This is a major issue, especially for sectors that are capital intensive or startups or greenfield operations. Such investments take long to break even. And this loss carry forward is really going to affect them. This particular proposal calls for lobbying. The business sectors really need to come forward and lobby about this particular issue, because many companies incurred a lot of losses, especially during COVID and afterwards. The economy has not been healthy from 2020 when COVID hit, 2021, and many businesses, especially large businesses, have been carrying losses. So if you take this as an example, it means the losses that were incurred, that were realized in 2020 will be expiring by the end of 2025. And yet some of these losses are significant. Major investments, especially in real estate or in large manufacturing, you cannot break even in less than 5 years. It is only much smaller businesses, much smaller investments that break even within that particular period. So this particular proposal really calls for lobbying for it to be recalled. If it goes through, it means now 2 things have to happen. If this particular clause goes through, it means 2 things have to happen. You have to look at your business and restructure it so that you can see what kind of revenue can be accelerated in recognition to offset part of these losses. Some businesses may even go into mergers to utilize a significant amount of losses that are still out there. So this issue of tax losses carry forward requires special attention, especially in lobbying. It is a critical issue. We need a situation where businesses that make loss, that realize losses, can be able to utilize them. It is a key area of concern. The second development, which is positive, is APAs. This is advanced pricing agreements, which KRA, if this proposal passes, and if this one should pass, you will be able to enter into an agreement with Kenya Revenue Authority on the transfer pricing treatment of your related party transactions. So, for example, if you are paying for services to your head office, you can agree how that particular pricing is to be structured, what amounts we are looking at. If you are selling goods to your sister company in Uganda or in Tanzania or in DRC, you can agree on the transfer pricing treatment. And this also goes for entities that have sister companies in the preferential tax regimes like EPZs, SEZs. You can enter into a deal with KRA such that your transfer pricing arrangements are known beforehand and it is very clear. So this is a positive and welcome move. We look forward to it being retained. Last year, we had lobbied aggressively for this particular clause, but what happened. This time around, this should come in. Now, what is the implication of this? Means if you're a large company with this kind of transactions, you need to take advantage of this. Prepare an APA agreement proposal to KRA, go through the process of negotiations, and then have a deal. This will ensure that you don't have disputes that are popping up from where you don't know. You really know exactly what your transfer pricing treatment is. And this is to ensure certainty for business planning and also to limit disputes. We don't want a situation where you don't know where your international tax disputes are going to emerge from and what positions KRA is going to take. An APA ensures that everyone is on the same page. The next development is a minimum top-up tax. Now, this is a development that has been happening globally, and Kenya is just jumping into the global minimum tax agenda. What it means is that if you are part of a large multinational group which has a turnover of more than 700 million or euros, global consolidated turnover, then it is required that there needs to be a 15% minimum tax. And if the effective tax rate for that particular member of that multinational group is below 15%, then Kenya Revenue Authority will add a top-up tax to bring it to 15%. So we wait to see how this will affect investments in incentivized sectors like special economic zones and export processing zones. Additional guidelines are to be prepared to facilitate this, but this is really what it is. It is meant to ensure that large multinational groups are not escaping taxes and just doing shopping of locations to undertake tax arrangements in specific countries and thereby lowering their effective tax rate. The other one is digital economy taxation. Special significant economic presence tax is a tax in the digital sectors. So it is a tax that if a multinational entity, most of the entities that are affected are digital or tech companies that are providing services directly to people in Kenya. If you are in such a situation, this tax will recognize the income which is derived out of Kenya, and even the threshold that was there of 5 million has been removed. The implication of this for those multinational entities or for those digital businesses that have customers here in Kenya is that they will have tax obligations in Kenya. So most of the people attending are not in this particular category. But there are players in this market which buy services from these digital service providers. And what we know them to do they simply just load that particular tax to you. So those who are reliant, those whose businesses are reliant on these particular platforms are likely to see price escalation for their services just by these entities just loading that tax to them. Then there is a more disturbing development for the specifically incentivized sectors. This is cutting out the 15% corporate tax rate for motor vehicle assemblers and affordable housing developers. These two entities in real estate and in manufacturing have been incentivized so that Kenya can arrive at fast for manufacturing of assembly of vehicles, so that Kenya can improve its profile and capacity in manufacturing of vehicles, because the automotive sector has a good spiral effect on the other subsectors in the manufacturing space. The other one is the housing, because affordable housing is specifically incentivized so that the prices of those houses are as low as possible, and they're only available to people really who really need this kind of housing. This is not a good development, because these sectors, especially affordable housing, the agreements that the developers already have with government have specific price caps. You cannot sell these housing units beyond a certain price, and that has already been built in the model. And we wait to see this is going to attract serious lobbying, because if it is implemented together with the VAT on these sectors, we are likely to see a complete drop in these projects. This can really kill the projects. Then the next development is the application of withholding tax on all software payments, especially software payments being made by distributors or by sub-developers, people in the industry. Especially this is going to affect the IT industry big time. So far, what has been happening is that only the final consumer of the intangible, which is the software, pays the withholding, deducts the withholding tax, because he's the person who is enjoying the IP. IP, intellectual property, moves from the original manufacturer, and it doesn't move across the supply chain. It goes eventually to the final consumer. That has been the person who has the withholding tax obligation. But this proposal there then means that everybody in that particular chain will have to apply withholding tax. This also is going to really attract a lot of it, because it can severely harm this sector. I'll now hand over to my colleague Magdalene to take everyone through employment taxes and the implication on taxation of SMEs.
Thank you, Steve, for the insight. We're having a technical challenge with the camera, but perhaps we could be proceeding with the presentation. To the participants, good afternoon. Allow me to take you through the things that relate to individual taxpayers and SMEs. Let's start with the first one, which is the PDM allowance. We all know that the limit has been 2,000 previously, and now it has been revised upwards to 10,000, relating to the costs that relate to subsistence allowance for employees, issued relating to meals, costs relating to meals and lodging. All this will be tax exempt up to 2,000 per day. You all know that this has been taxable above 2,000 before, and now this is a big relief for companies and their staff, and especially for those staffs who travel frequently on international travel. the 2,000 was unrealistically very low, and with this proposal is recognizing the high cost of travels. And in this case, you can see some of the employees are going to pocket some savings. Thank you. Thank you to the IT team. We are able to proceed. So I was still talking about the PDM allowance and the increase in the limit up to 10,000 in relation to costs relating to meals, subsistence allowances, and lodging costs. So you can see the amount has been increased, and it's a big saving for those employees actually who travel on international travels, because the 2,000 was very unrealistic for international travel. This proposal recognizes the high cost of travels, and it's going to make some savings, additional savings for the employees. And for the sake of the employers, it also reduces their taxable reimbursement procedures in the case of accounting for such. We have another proposal, and this one touches on the SMEs. This is a proposal of 100% deduction on the tools and equipment. But remember, this one, it only limits itself to the diminution value, meaning the tool has been defined, so it doesn't include plant and machinery. And this one is going to be a positive move for the SMEs because it's immediate expensing, which gives a tax break for SMEs. And in the case of the SMEs, we are going to see some savings in relation to reduction in taxable profit. And in the case of also extracting the tax relief, because they will earn this in the first year of use 100%. So in the case of SMEs, this one will improve cash flows, and it creates a pool for reinvestment. So in the case of the government, I think this is a move also to align with agenda to support the small businesses to grow and thrive in the Kenyan economy. In this case, the proposal does not actually define what SME is, but we are guided by the definition of an SME, which is based on maybe turnover or some other threshold, which we believe the bill is going to clarify. In this case, for SMEs, it's a positive move, and we advise that the SMEs should be able to take advantage on this, and then maybe plan for capital expenditures and to maximize the tax benefit. We have another proposal which has come up in the case of the home ownership incentive deduction. Initially, it was 300,000 per year. This is being revised upward to 360, and this one relates to the home ownership plans for owner-occupier constructions or construction of residential houses. Now, this move it is going to reduce the taxable income on the part of the owner of the house or the resident. So in this case, the 300 to 306 also reduces the taxable income because it's a deduction, giving a tax break for these individuals. And in the case of this, we are going to see a spike in demand for housing loans. So in that case, construction industry will be impacted. So to me, it looks like it's complementing the affordable housing agenda, which is now incentivizing the private individuals to build homes. So in the case of the employers, it's something or a point to communicate to the employees and especially those in the middle management to undertake this. It also creates disposable income for the employees, which also impacts positively in the economy because they have some money to spend. And spending means business growth, impacting into the Kenyan economy positively. So we have seen another proposed change in relation to the individual taxpayer. We have the payee simplification in the case of administration of tax relief. The bill proposes that all the tax reliefs and exemptions and all deduction relating to individual taxpayers will be handled through a payroll in the case of the employers. So, and this does not require now the employee to apply separately through the treasury or through the KRA. So it reduces the challenges that employees may face if they have to take the route of going straight to the treasury or working with the KRA. But on the part of the employer, this is going to require some sense of responsibility to ensure that the overall process is streamlined. So in this case, the government is trying to save the employees from any challenges of applying for relief. So we are seeing reduction in bureaucracies in the application of the tax relief. There is another proposal, the fringe benefit. You all know that fringe benefit is a tax that is subjected to preferential loans that are given to employees, but at subsidized rates, interest rates, lower than the market rate. So usually, this is a process of determination. We compare the rates that the employer is applying, and we compare with the market rate. And this fringe benefit market rate is usually determined by the commissioner. Currently, I think 13%. But now, this, after we determine the variance, we subject it to 30% tax on that. This rate is now being aligned or is being in tandem with the corporate tax. So it means if the corporate tax rate changes, then the fringe benefits rate will also change. So this is not something to actually worry about. It's something indicative, but it's something also to note going forward, because of should the corporate tax go low or go high, then it means a change in the application of the fringe benefit. We have the last item that I want to mention, and this is on digital asset tax. In 2023, there was introduction of the digital asset tax on all the income that relate to exchange or transfer of digital assets. For example, we have the cryptocurrencies, trades, and such other digital asset tax. So the rate has been 3%, and the bill is proposing that the rate reduces to 1.5%. Possibly this is a move maybe to encourage innovation and also to spur the digital and fintech space, creating more market. But then this could also be a move maybe to drive or to open up the activity that may have been going underground, and by making it maybe palatable to improve compliance. In this case, this rate of 1.5, you can see also, it's also aligning with the digital service tax rate of 1.5%. And that standardization is a good approach, and especially to digital related levies. So in this case, Kenya is trying to be friendly, at least to the digital economy, but at the same time, we can see also it's tightening the digital measures to curb any lack of compliance. So at this point, I wish to introduce my colleague who will take us to the next slide, Barbara. Thank you so much.
Thank you, Magdalene, for the presentation. I'll now take you through the VAT presentation for the proposal for the finance bill. So we'll start off with the change in the rates. So you'll find that some items have moved from zero rated to exempt, and others from exempt to standard rated. So I'll start off with the zero rated to exempt. So the proposal for this is that basically, let me take you through what zero rated means and what exempt means. So zero rated means that you don't charge VAT on the sale, but you can claim back any VAT paid on the inputs. Exempt means you don't charge VAT and you cannot claim back the input VAT. So some of the proposed changes from zero rated to exempt are inputs for animal feeds, solar and lithium batteries, electric buses, locally assembled phones. So the implication for this is that non-deductibility of input on exempt supplies may affect cash flows And also VAT refunds will also not be possible, as you can't have a VAT refund on the exempt supplies. And then the next one is proposed change from exempt standard rate. So for standard rate means that you charge VAT on the outputs, and you can also claim VAT on the inputs. So the government's perspective is that those who invest in this can now claim input VAT. So it's moving the VAT in one step ahead in the chain. So some of the materials that are proposed to move from exempt standard rate are materials for affordable housing, specialized hospital equipment with a minimum bed capacity of 50, and this has to be approved by the CS. And then inputs for oil, taxable goods imported for exclusive use in the mining and geothermal by a company granted a prospecting or exploration license. But for this one, if the bill goes through and this proposal goes through, the exemption will go on up to June 2026. And thereafter is when the item will move from exempt to standard rate. Then there's also the transportation of sugarcane from the farm to the milling factory. So for this one also, what happened before is that the Finance Act 2021 made this item actually zero rated, prior to that it was exempt. So if this actually goes through as a proposal and goes through the act, it will move back to standard rate, meaning that you will not be able to claim lodge refund claims on the transportation of that. So basically, if goods move from exempt standard rate, it means that they'll become more expensive because you'll have to pay the additional 16% in the cost. And then we move on to the VAT refunds claim window. So currently, VAT refunds can be made on excess input tax attributable to zero-rated supplies, and also excess input tax attributable to withholding VAT. So currently the time frame for lodging a refund is 24 months, but it's proposed to move to 12 months. So what this means is that if you don't lodge within the 12 months, you might forfeit the refund and you won't be able to claim it in future. So this would be a shorter window to claim the input VAT. And then one other item is a refund on VAT on bad debts. So currently refund on VAT on bad debts, a bad debt basically is classification such from the period of 3 years, and you have up to 10 years to claim the refund on the VAT on bad debts. However, there's a proposal to change this stat. You can claim it from the 2-year period from the time of supply. This will be a good move because you'll have more time to claim VAT refund on bad debts. That will now be 8 years. And then I'll take you to the next one, which is career refund processing. So these are refunds for VAT. So currently the law provides that a refund decision for VAT should be given in 90 days. However, the proposal is to move this to 120 days. And in case there's an ongoing audit or investigation, it would move to from 90 days to 180 days. So this would basically mean that longer wait for refund decisions may lead to negative cash flow for businesses. And from the government's view, this would also ease administrative burden because they would have more time to review the refund and go through the internal processes before they give the refund decision. And then the next one is invoicing compliance. So definition of tax invoice has been redefined in the VAT Act. So a tax invoice is defined to include e-TIM's electronic invoices, reinforcing use of electronic register system. So basically what that means is that reinforcing that businesses must use e-TIMs for their VAT invoices. And also the VAT Act states that a taxpayer should issue a tax invoice for a taxable supply. So basically a taxable supply is zero-rated supplies and 16% supplies. And the proposal proposes to remove the word taxable in that case. So it will mean that a tax invoice should be issued for all supplies, meaning for both taxable and exempt supplies. So this is just for realignment and making it clear on what e-invoicing is and what a tax invoice is. And then the next one is, okay, so basically there is no much change on the rate of VAT for basic commodities. So you'll find that for example, basic commodities, for example, for fuel, the rate is still at 16%, it's not been touched. Another item I would say is ordinary bread, it's still zero rated, that has not been touched as well. So in this bill, you find that there are no major changes for VAT and therefore no new rates for VAT. And then I'll take you through excise duty. So for excise duty, so the changes mainly fine-tune definitions and close loopholes, especially concerning the digital economy and financial services, and make an administrative improvement on licensing. So for example, digital service, we find that last year, the Tax Laws Amendment Act 2024 introduced excise duty on services provided by non-residents over the digital marketplace. So for that one, it only talked about the digital marketplace, but now it's also gone ahead to include provided over the internet. This is just a clarification to show that it's not just over a digital network, but also through the internet. So that's just expansion of the definition of digital service. And then for this one now, it's about, this change is about equalizing the tax treatment. So you'll find that locally, these services were also excisable. Services provided by residents were also excisable, but now it went on to also include for non-residents. So it's just about equalizing the tax treatment. And then the implication for this is means that KRA will be able to collect excise duty from these services from provided by non-residents to people in Kenya. So basically, they increase their revenue on that. And then there's also a proposal to include the definition of a digital marketplace, which is an online platform which enables users to sell or provide services to other users. So this mirrors the definition as per the VAT Act, which is already there currently. And then digital lender. So this has been redefined. So currently a digital lender should be licensed under the Central Bank of Kenya. But this is going to be, there's a proposal to expand this definition to also include those not licensed under the Central Bank of Kenya. For example, this could be digital lenders who use mobile apps and are not registered. So the current excise duty on fees, for example, on loan fees is 20%. And if this bill goes through, more loan fees and more excise duty will be collected from those ones not registered. So Kenya has seen a boom in the digital lending apps, which are mobile loan apps. These are outside the traditional financial system, so they are not registered under the Banking Act or the Microfinance Act. And this means that all those digital loan apps and maybe also Shylocks operating from via mobile will now fall under the excise regime for the loan fees. It removes the licensing criteria from the definition. So whether or not the lender is recognized by CBK, if they lend online, the excise fees on the loans will be applicable. So the implication for this is that if this proposal passes through, more people will be required to register for excise duty because they'll have to pay excise fees on these transactions through digital platforms. And then for excise licenses, currently the Excise Duty Act does not give a time frame whereby the KRA is meant to approve your application for excise. So there's a recommendation that there will be a 14-day approval timeline. So basically the implication for this is that there will be quicker time for market for businesses under excise regime. For example, licensed manufacturers or importers of excisable goods will be able to operate faster once they get the approval for the excise license. And then there's also another one just for streamlining purposes. So excise classification aligned with EAC tariff codes. So the bill says that goods for excise purposes will be classified according to the East African Community Common Tariff External Tariff Codes. So basically, this is to align with import duty and excise. So basically, what will happen is that there will be no issues with classification. This will result in lower disputes in terms of classification and charging of excise duty on goods. For example, if there's a debate on what qualifies as sugar confectionery or a motor vehicle for excise, the tariff code can be extracted and it will guide on the excisable value. So the implication for this is it will also prevent or reduce disputes with KRA in terms of classification on the amount to charge excise duty, which is the excisable value. And also you find that in excise, over the years, there've been many shifts in items such as excise on gaming and betting industry, tobacco, alcohol. So in this finance bill, there are no proposed changes in that. So basically we'd say this is a good move because it gives a relief to those industries that have faced significant hikes in the past years. So that's the presentation on excise duty and VAT. We'll move on to the next presentation on miscellaneous fees, which will be done by Koti Mwanzia.
Ladies and gentlemen, good afternoon. There we go. I can be seen. Good afternoon, ladies and gentlemen. We can be able to actually see we are a total of 294 participants. So very welcome for being a part of the experience thus far. Now we're going to move on to the miscellaneous fees and levies, the proposed amendments to the Miscellaneous Fees and Levies Act. So maybe we can move on to the next slide kindly. Lovely. So you will realize that the Finance Bill of 2025 has proposed to make an amendment of the Export and Investment Promotion Levy from 17.5% to 10%. And this is indeed key specific to iron and steel products. It's imperative, first of all, to have an appreciation for why exactly does this levy exist. And you will realize that the Export and Investment Levy promotion levy exists to foster and grow the manufacturing sector, as well as improve exports growth, create job creation, save a little bit of forex here and then, of course, further promote investments in the country. As we had mentioned rather in the beginning of the presentation with Steve Okoth, where he had given and made a reference to the affordable housing current projects that are ongoing in the country, you realize that this proposal is actually steered towards that. A reduction of certain rebars and steel of a specific HS code number perpetuates reduced cost of construction. So therefore, this proposal is actually great news for the affordable housing project, the real estate industry, construction, as well as to further grow the proposals surrounding the public-private partnerships that everybody in the Republic of Kenya is currently having discussions over. Very recently, our President, His Excellency, was in China, furthering collaboration between ourselves and the Chinese government to see how these PPP projects can ensure and foster growth in the infrastructure sector. So therefore, this is indeed a welcome proposal, considering that it will reduce the cost of construction as we endeavor to expand and grow the country's infrastructure portfolio. The key query that we ask ourselves as tax consultants is, will this indeed translate to a saving element? That is a primary question that is imperative for us to appreciate. But that notwithstanding, we wish to reiterate for those particular industries, more so for the affordable housing projects, real estate and construction sectors, that is indeed a very welcome proposal. We move on to the IDF and RDL exemption being narrowed to specifically target large size aircrafts. For those travelers in the audience, I think that this will of course be great news. And one of the imperative aspects of the same is originally this exemption was consumed in more of a blanket approach, but you realize that this exemption and the proposal is geared towards specific tariff codes. And you will realize that the larger carriers, and not the smaller aircrafts actually, but more so the larger air carriers are those that will be benefiting from this proposed exemption. Classic example, and I mean, it would be great to hear if we had anybody from Kenya Airways, the pride of our great republic. They reported a profit for the first time in many, many years, a profit of 513 million Kenya shillings for the first time in 11 years for the period ended June 2024. So you realize that such kinds of proposals are geared towards certain industries in order to further support the growth of the industries themselves. So indeed, it is a welcome move, more so for fellow travelers. So that would be a great one. Will this translate into reduced fees of travel? We anticipate the same shall apply, but of course, the carriers of larger scaled aircrafts will be happy about that proposal. Finally, we move on to the exemption. There's a proposed exemption to exempt the Kenya Revenue Authority from stamp duty on the transfer of property that has been indeed transferred to the Revenue Authority in a bid to collect any revenues or rather any taxes that were unpaid. So there is the proposal to exempt the Revenue Authority from stamp duty. Of course, we appreciate that this is more an administrative proposal to ensure an ease of the administration, whereas the Revenue Authority, or in areas and in instances where the Revenue Authority transfers property that in a bid to, of course, offset any principal taxes. There are no new levies, of course, which is great to hear in terms of the IDF and Railway Development Levy. They remain just as unchanged, but it is imperative to appreciate, should your products engage within the respective HS codes of the proposed changes that are welcome, I believe it's imperative to appreciate the codes that associate with your trade. We can maybe move on to the next slide, kindly, Meha, where we're discussing on tax administration and compliance. To be very honest, this for me is one of the greatest acts. I don't know about others. And the reason why I enjoy the Tax Procedures Act is because it really articulates succinctly in a manner that is interactive how taxpayers interact, exchange ideas with the Revenue Authority. And just in its kind and in its title, it is quite literally the Tax Procedures Act. It's very insightful for what your rights are as a taxpayer, but also what your obligations are to the Revenue Authority. Whereas, of course, it is about knowing and appreciating what your rights are, there are also expectations from you as a taxpayer. Notwithstanding how the Revenue Authority interacts with you, that is the premise of this act. So whenever it comes to how like Kenya Revenue Authority audits, compliance reviews, post-clearance, any interaction that you have is always enshrined clearly and succinctly within the Tax Procedures Act. Why is it important to appreciate any changes within this act, or like right now we are proposing that dissecting the bill, is so that you understand and have an appreciation for what changes are there that will affect how you navigate with the Revenue Authority. So the first one is a hot topic, which of course is the tax amnesty deadline. I wish we could be able to see and interact with all of you that are currently logged in. But it would be great for us to appreciate that the tax amnesty deadline actually does lapse on the 30th of June 2025. And of course, for those that are aware, this was an initiative by the Kenya Revenue Authority and the National Treasury to seek ways in which they can be able to collect revenues through the inspiration of settlement of principal taxes, and therefore subsequently enjoying a waiver on interests and penalties. So if you have not done it, guys, it is time to act now. As you can see there in the slide, act now or lose. We anticipate, should you be able to have these discussions with your tax consultant, of course, preferably BDO, but we encourage you to have these discussions with your tax consultant to ensure that the amnesty is something that you take advantage of. And why is it that the National Treasury, as well as the Kenya Revenue Authority, is keen on this? You will realize that the Kenya Revenue Authority collected up to 20.8 B, that's a letter B, guys, billion in overdue taxes, whereas the Revenue Authority also collected 28.7 B of unpaid taxes. That's 28.7 billion Kenya shillings. So you will realize it is imperative. There is the impetus for you to be able to consume of the tax amnesty. Of course, do that in collaboration with your consultant. We have the penalty waivers for system glitches. We are moving into a digital era where we are digitized, we are automated, we are embracing artificial intelligence, and the same applies also with the Revenue Authority. How, therefore, can we create a buffer with regard to how to navigate these digital dynamics? So there is a proposal where the commissioner is empowered to waive any penalties and interests if a taxpayer defaults due to the Kenya Revenue Authority system glitch. Yeah, we all know and we have all experienced on that 20th of that month, we are trying to file our VAT return and the website is just not delivering. It can be frustrating. It gives very many taxpayers a lot of anxiety on when the due dates on certain statutory payments are due. Therefore, this proposal is extremely welcome as it shall cater for any system glitches on the side of the commissioner. However, there is a caveat to the same, where in any single statutory provision that allows the commissioner, or rather that the empower has been given the powers to execute something, you must show cause. Remember, we cannot lose sight of the Tax Procedures Act that says the onus rests with the taxpayer. So therefore, the question becomes, what shall culminate into proof, so that way we can be able to compel the commissioner to waive penalties based off of a system glitch. We have the withholding tax relief. Withholding tax is rather an agency tax where a client, or rather a taxpayer, is appointed as an agent to withhold and remit taxes on behalf of the Revenue Authority. These kinds of agency taxes are applicable in a way where it becomes your responsibility to withhold certain values on qualifying amounts. So therefore, what is the proposal fundamentally and intrinsically? The proposal is such that in the event that you do withhold, if you do not withhold tax for any qualifying payment to your supplier, you realize that your supplier will have disclosed that value in their profit and loss, and rather in their financial statements, and therefore as taxable revenue. You realize that if they have already disclosed that from the angle of revenue on their side, why is it therefore for me, I am subjected to withholding tax on the flip side, and yet there is no revenue leakage for the Revenue Authority? You realize that, that is more a compliance dynamic, and the proposal that has currently been made is to ensure that, you know what, as a taxpayer who is supposed to withhold, As opposed to being penalized, you will simply be penalized for the lack of compliance and not as a percentage of the amount you should have with them. For those that have had carry audits, I know it's been aggressive, especially around that section, but this proposal is welcome not only from the punitive side, but also it shall foster continued collaboration with clients as well as various suppliers. So here's the dynamic, as I had mentioned prior, with regard to the Tax Procedures Act. It's a double-edged sword. It's about how you interact as a taxpayer, as well as how the Revenue Authority interacts with you. There is a proposal where there shall be, the commissioner shall now is going to be empowered to issue agency notices even at appeal level stage. Here's the dynamic about this. And I know we had very interesting discussions as BDO Tax Department around this particular proposal. We feel like it's evolved over time. Where I mean, even during the entire appeal process, how can we ensure that there have been proposals historically where the commissioner anticipates to be paid before an appeal, up to 20%. There was a proposal, I believe it was the 2022 proposal, where you are expected as it was proposed that the taxpayer should pay 20% of the appeal value. So I feel that this provision has evolved over time. And now where now the proposal for the commissioner to issue agency notices, even at appeal stages when it is pending, I mean, it's as good as trying now to, like even the slide says, pay now, argue later. We wonder where that canon is enshrined from a compliance perspective. I believe that whenever there are areas of contention, it is important to interact with the Revenue Authority in a carry audit review process in a manner that is collaborative to ensure that taxes actually due are paid, and not an instance where you pay now and then, of course, argue later. This is a proposal that we are squinting at, so we look forward to seeing it's not being involved in the act. Of course, you can only tell subsequent to that. Of course, then the next issue is with regard to disclosure of secrets. In Kenya, we have the Data Protection Act of 2019. We wonder how this proposal exists in synchronicity with the Data Protection Act, because as the way the proposal has been drafted, you will realize that the Kenya Revenue Authority shall have access to personal recipes, IP secrets, secret formulas, and we wonder how will this information be consumed by the Revenue Authority should this proposal pass. I know there are confidentiality concerns, whereas we appreciate that the Revenue Authority is indeed an arm of government, and they are sworn from a respect of ensuring that any information that they collect about taxpayers is handled in the most confidential manner. I mean, it's still yet to have an appreciation for how can such a provision exist without further expansion for how this information shall be collected and how it shall be treated. So that, I believe, is still a drafting dynamic that requires us to have a review over. And of course, there's the proposal for the operation timeline to be based off of calendar days and not working days. Believe it or not, this one now reduces the timeline for when you have your ability to, for example, 30 calendar days to submit an objection, rather 60 days to have an objection decision. So it's now based off of calendar days and not working days. So the period for responding to various Revenue Authority communications reduces. So that is a double-edged sword, we would like to say. And of course, another glaring issue is the enforcement to non-residents. There is a proposal where the Revenue Authority shall extend its hand from an enforcement perspective to non-resident entities where agency notices and asset seizures can be initiated by the Revenue Authority. This is whereas we understand and we appreciate that Kenya is, of course, following suit with the global trend to ensure that we adhere to various base erosion and profit shifting control mechanisms. As at right now, we need to see the nuanced elements of this proposal. So maybe that's from the Tax Procedures Act. I mean, of course, always feel free to ask your questions in our chat box as well as the chat as well. But I believe we can move on to the next slide. So industry-specific impacts. Why is this important for us to have an appreciation over? Whereas we have dissected all the individualistic proposals, it's imperative to have an appreciation for how certain industries that are being targeted by these proposals, how that affects current and also envisaged operations. We have the manufacturing sector, where we have the lower input costs, considering the discussion that we've just had with regard to the steel input levy cut from the 17.5% to 5%. This means the raw materials, especially for the construction, machinery and automotive industries, will definitely enjoy lower cost of production. And of course, this shall boost projected margins as well as potential investments. Then we have investment deductions where there's a proposal to have 100% investment allowance withdrawn for large projects outside Nairobi and other SEZs. But now it's not going to be staggered in a similar manner and in a similar fashion as is enshrined in the Income Tax Act. We have incentives to be removed, where especially more so for local assemblers, local vehicle assemblers and manufacturers from the 15% corporation income tax rate to 30%. We have excise duty license fast tracking. There's a proposal to it at 14 days to ensure faster and quicker startup for the respective factories, for example, in the breweries and of course the fuel blenders. We have the energy and fuel costs. Fortunately, I know very many of us were anticipating to see a proposal of the change of VAT status of fuel, but unfortunately that proposal has not seen the light of day. So we'll wait and see what happens in the Finance Act, ladies and gentlemen. And of course, the loss utilization that was discussed at the income tax section of the slides, which once again, we wish to reiterate, it's important for you to, should this proposal see the light of day, it shall be somewhat detrimental to yourselves. Then let us now move on to the digital economy, to which I will now hand over to my colleague Ida. Thank you.
Good afternoon. I'll delve into the impact that will be impact by the proposed finance bill on the digital economy and the tech industry. The Finance Bill 2025 is not different from the previous bills, the Tax Law Amendment Act 2024. So the Finance Bill 2025 continues the Kenya's aggressive stance towards bringing the digital commerce into the tax net, although it has sweetened some aspects to encourage tech growth. I'll dissect on the negatives and the positives that shall be brought in by the bill. The first tax that we look at is the significant economic presence tax. So the bill proposes to increase scope to cover not only services provided over a digital marketplace, but also services carried over the internet and the electronic network platform. This is not a new tax. It was brought in by the Tax Law Amendment Act 2024 to replace the digital service tax. In addition, the bill is also proposing to remove the minimum threshold of 5 million shillings. So that means revenue subject to SEP will include even the moderate revenue. Everyone under virtually all online services shall be subject to SEP. In addition to what the bill seeks to propose with regards to increment in scope of taxation is the excise duty on imported accessible services. This is not a new tax, but the bill also seeks to increase scope for these services. Initially, it will excise duty on accessible services, imported accessible services
was covered services offered over a digital marketplace, but the bill proposes to increase this scope to include services offered over the internet and the electronic network platform. So we expect that your invoices from Facebook ads will now have an extra charge, inclusive on the VAT charge that was initially there for registered service providers. VAT will be claimable, but for excise duty, this will not be claimable. Other individuals that have not been left out by the bill are the unregulated digital lenders. The bill is proposing to tax all loan-related fees by unregulated digital lenders at an excise duty rate of 20%. This will raise costs for quick loans, and we might see a push whereby lenders will now seek regularization or partnerships with regulated lenders. Some of the positives we see that withholding tax rates on digital assets, on transfer of digital assets, that's crypto trades, has been cut to 1.5% from 3%. This will encourage crypto exchanges and fintech innovation. Speaking of innovation, tech startups that have been certified under the Nairobi International Financial Center will have, or rather will enjoy corporate tax of 15% for the first 3 years, then 20% for the next 4 years. So virtually we see 7 years of reduced tax. This will be helpful for early growth for such startups. Major tech players have also not been left out when it comes to the Nairobi International Financial Center, whereby if you attract large investments of 3 billion, or make Nairobi your headquarters, you will also enjoy bigger and long-term breaks. That is 15% of your CIT for the first 10 years and 20% CIT for the next 10 years. So virtually 20 years of tax breaks. That should be advantageous to the tech companies. Also, in addition to that, there are dividends that are paid by NIFIC certified companies. If you reinvest back 250 million, your dividends shall be exempt from withholding tax. So we see this measure will make Nairobi a tax advantage tech hub for those willing to commit significant capital investments. Just to rush through some of the impacts of to the digital economy. So I'll quickly pass on to Steve because of time for him to take us to the next session.
Okay. I'll go to the priorities, the priority areas, and what to do next after this bill has now been tabled, because it has now been tabled, and the journey from there all the way to enactment. One of the key risks that are there is that the industries that are affected by these changes, especially negatively, you need to now think of your cash flow position, how this is going to affect the cash position, and how it's going to affect the business. This planning needs to commence. Even as people are engaging the lobbying exercise, that particular thought process needs to be engaged. The powers that have been given to KRA for aggressive implementation of their mandate, and especially even going into enforcing disputes that are still underway in the judicial bodies. Of course, that particular aspect has constitutional aspects and it can be challenged constitutionally, and chances are that it will be dropped in the lobbying process. But there are other measures that are likely to pass, especially enforcement mechanisms where a dispute has actually fallen into place and it has properly been determined. These are areas of concern. So if you have a tax position which is already potentially in dispute, an aggressively progressing audit or a dispute has actually crystallized into an assessment or an objection decision, then it needs to be carefully looked at. You can have a sit down with experts, and then the risk is evaluated and a proper strategy is put in place for management of those particular disputes. This is really the time to look into this. There are sectors that are going to be impacted where products are being moved from zero rated to exempt, or products which were either previously zero rated or exempt being standard rated. The implication of such a transition, if it succeeds, because government is taking a strong view on cutting out exemptions, cutting out zero rating, limiting them significantly, then the implication of this for business needs to be evaluated in good time. And then the transition to that particular tax treatment, especially the tax procedures that have to be put in place to facilitate that transition successfully and cost effectively, they need to now begin being thought out. I think some of the products that have been brought into the standard rating are going to succeed, and they're going to pass through into an act. There are some opportunities, but this is mainly for the Nairobi International Financial Center. Those who have large investments, this is an opportunity to jump into this scheme and take advantage of it. It will not be wise to leave this particular advantage. There are incentives to individuals that are going to enjoy greater deduction, people who are traveling. This is really some of the opportunities that are there. To structure business to take advantage of the tax leeways that are available, that planning needs to be in place. Now, this compliance readiness, cash flow issues, and engagement of KRA in good time, these are now need to be put in place. Restructuring of projects, properly conceiving projects such that they take advantage of the opportunities within the law and opportunities that are going to come within the law. This is good time for planning. But at the end of the day, especially issues like restriction of loss carry forward, especially issues of affordable housing and for the automotive sector, sectors that are likely to be affected adversely, they have to go through lobbying. Lobbying process it works many times. Sometimes it does not work, but most of the time, lobbying efforts will succeed. We've been lobbying successfully for several years. Engage the lobbying. And for lobbying to be successful, the positions that are being articulated needs to be addressed in good time through several meetings, especially with members of the committee. They really need to get a good time to understand the issues that are being raised, the impact on business, the impact on investment, the impact on staff, or even business survival issues. They are going concern issues that arise if bad law is put in place. But besides even the ones that I'm mentioning and the ones that have been mentioned in this bill, for which work needs to be put in place, there have been some lobbying efforts that have not been successful. They were brought last year. The bill did not succeed. Some of them were in the bill did not succeed, and it collapsed. This is another time to bring them back. And even the ones which were not properly addressed. This always requires time, and it needs time needs to begin now so that this process can be successful. The lobbying effort sometimes requires that you also engage with industry groups, Kenya Association of Manufacturers, Kenya Private Sector Alliance, and the other industry groups. This really is quite important in making the lobbying successful. So it requires a multifaceted approach for it to succeed. So this really brings us to an end of the webinar. BDO is here to support people in understanding the implication of this bill on finer detailed specific industries or even specific transactions. We are also here to support in the event that a particular industry has evaluated this proposal and it's going to adversely affect them. We can support to help correct this such that by the time the act is coming out, it is properly worded. Understanding the implication of this bill is quite important. So this is really it. We bring it to a close. I hand over back to Meha.
Thank you to all the panelists, and a special thank you to all the attendees for joining us today and our very exclusive tax webinar on the finance bill. And we have more webinars coming up regarding tax, and so please keep a lookout on our LinkedIn page and in your inbox for any updates on our webinars. We have maybe 5 minutes to go through some of the questions if you'd like. Let me go through some of them. Okay, I have several questions in the Q&A tab. We were just organizing some of them. So if you all go into the Q&A tab, you'll be able to see a lot of questions have been answered by our team already. So you can just take a look at the answers our experts have responded to. There are a few more questions. So the first question is, there has been talk that gratuity and retirement benefits have been exempted from tax in this bill. He did not hear us mention anything about this. So if any one of the panelists would like to take this question, please go ahead.
Thank you, Meha. I would wish to respond to this question, perhaps we was skipped. I want to give a chronology of how this tax, the retirement benefit has evolved over time. Before 2024, this was based on the age, that is 65 years and age, and that is when the exemption would be applicable. The Tax Laws Amendment 2024 tried to extend this to include the exemption was to also apply when someone withdraws or earns some gratuity out of illness. Or another qualification would be if someone has withdrawn from a pension scheme, but has been in the membership for 20 years. So with this bill, it's proposing a section of the definition of individual retirement benefit is defined in section 2 of the income tax. And there is a section of that has been deleted. Remember, this determination of the pension, the individual retirement benefit is governed by the income tax, retirement and benefits rules. So a section of it has been deleted with a wording called subject to income tax retirement benefits. So this indicates that the determination of the the benefits of an individual, whether it will be paid to the person after attainment of the age of the retirement age, or even upon illness, or even the other qualification. But this, by deleting the subject, the word subject means the determination will not be based on income retirement benefits rules. So what we should ask ourselves is, what does this mean? The individual retirement benefits attract some exemption, and these exemptions are the ones that are governed for taxation of the retirement benefits. So it simply means now determination of that benefit to be paid to the individual or to their beneficiaries, then it will be governed by the respective laws, whether it's the pension fund rules, whether it is the home ownership rules or home ownership plan rules, or any other rule that is relating to that specific contribution fund. So it will not be subjected, it will not be governed by the income tax, retirement, and benefit rules. So then it means that the exemption that was being awarded because of being governed by the income tax rules then has been removed. So in this case, we can see what are some of the implications for the retirees. One, the whole income may be subjected to tax because it's no longer under exemption, because the wording that was governing was the subject to the rules and it's no longer applicable. So that subjection of the part of, for example, there was the first part, the 600, the first 600 was not subject to income tax. Now, because it is not now subject to those rules, then it means the exemption has been withdrawn. What does it mean even to the dependents in the case of death? Then it means then because of lack of that that provision, then the whole amount may be subjected to tax. So at the end of the day, this discourages the incentive to invest and to save in the pension schemes, because what was mostly attracting me was the fact that you get some tax exemption, and especially the huge amount. And for those, for example, who have saved huge amounts, then the first 600 would have been a major saving for the pension benefits. So in this case, I think the impact of that withdrawal of the lack of subjection to the rules, then it will mean that you are not subject to the exemptions, which is so demoralizing, and I think it's negative. It will have a negative impact on savings into pension schemes. I hope I've addressed the query.
Thank you, Magdalene. I think that's all the time we have for today's webinar. I'd like to extend my thank you to all the attendees and especially the panelists for putting up this presentation together. Yes. If you guys would like to just take 2 minutes to answer the webinar feedback survey, it will help us know how to improve on our future webinars and what topics you're interested in. And yes, that's all. Thank you.